Emerging market today is a combination of several different themes, not only just about cheap labor. For example, the two large emerging markets of Korea and Taiwan are the semiconductor hubs for the world, and almost entire AI supply chain is concentrated in Taiwan and Korea. So whether you buy chips from Nvidia or whether you buy chips from AMD, whether you use cloud from AWS or Microsoft, underlying components are all coming from Taiwan and Korea. So that's actually the large part of the emerging market today, probably the largest part between these two countries. The other big part about the emerging market today is the China and India, the two most populous countries of the world. And here it is much more about the domestic consumption. Specifically, in the case of India, it is about services and the domestic consumption. China, yes, has been the factory to the world historically, but China also is focusing much more on the advanced manufacturing, like robotics, like electric vehicles, like advanced semiconductors, and so forth. So I think it is probably unfair to characterize emerging markets only in the form of cheap labor. So growth in different emerging markets, obviously there are different drivers, and that's the beauty of the emerging markets, that there are quite diverse growth drivers within the emerging markets. So for example, the Latin American markets like Brazil, Mexico, Chile, Peru, those are relatively more commodity driven. Middle Eastern markets like Saudi Arabia, UAE, as you can imagine, those are more energy related or energy driven. Whereas we spoke about earlier, the technology heavy markets like Taiwan and Korea are about semiconductors and the other industrial businesses. So there are multiple kind of growth drivers. Trade is important, but I would say domestic consumption growth almost in every emerging market is also an important driver of growth. And hopefully now with some better kind of certainty around the tariffs between US and the global economies, the trade related uncertainties are the peak uncertainties around the trade are somewhat behind us. Now obviously we have the current Middle East war to think about and worry about, but that's a universal shock of the energy or the higher oil prices, which is relevant for every market. And whether it is emerging or developed, all countries are going to face the supply shock from the high energy prices. So emerging markets are not kind of singled out in that case. Korea historically was one of the cheapest markets in the emerging market. There always used to be a term used, Korea discount. And the reason for that was the corporate governance in Korea was not supposed to be best in class. The reason why the Korean government and the Korean regulators are very actively trying to improve the Korean discount or to remove the Korean discount is because they believe that there is a genuine case here to improve the corporate governance practices. I'll give you some examples. So, for example, the related party transactions are now under much more scrutiny in Korea. The dividend payouts, the shareholder, the buyback of the shares are actually incentivized by doing better tax reforms, or let's say by doing the tax reforms which incentivizes the higher dividend payout and higher shareholder buybacks. There are also changes which effectively changes the liability of the independent directors or the responsibilities of the independent directors towards a much broader set of stakeholders. So we are seeing some really interesting, changes in the corporate governance practices in Korea, and that is one of the reasons why over the last couple of years, apart from the big semiconductor or the AI trade, which Korea is obviously beneficiary of, we believe that the improving corporate governance is also one of the themes why Korean market are doing well. In China, we have seen historically the move towards the SOE reforms, state-owned enterprise reforms. One very tangible change which was done a couple of years ago was the return on equity was the KPI or the key performance indicator for the SOE management. Historically, it was not the case, but now the SOE managements also have return on equity as one of the KPIs. So these are some of the areas where we are finding, interesting reforms on the corporate governance side in larger markets like China and Korea. Yeah, so I think the low correlation among different markets means that obviously, some of the markets like China, Taiwan, and Korea, because they are the large exporting economies, their correlation with the world economic growth is much higher. Whereas if you look at the markets like India, Indonesia, Philippines, and some of the other ASEAN markets, those are far more domestic consumption driven. So you will always have, within emerging markets, some markets doing well because the global economic cycle is doing well, but some of the other markets will, perform better in other times when it is much more driven by the domestic consumption and all that. So this makes the emerging markets really diversified in that sense, and we can see that in terms of the divergence of returns of different countries. For example, 23-24, India was one of the strongest performing emerging market. 25, Korea and Taiwan were the strongest performing emerging markets, other than the Latin American market. So each year you will see different markets kind of taking the lead, and that's par for the course in our view. At Ashoka WhiteOak Emerging Market Trust, we generally do not take top-down calls on countries or sectors or any particular themes. We believe that our core strength is more in stock selection, finding the great businesses and buying them at attractive valuations, and keep holding them over a long period of time. I mean, that's very simple bottom-up stock picking driven philosophy which we follow. Obviously, we are aware of the evolving macro realities, but from a portfolio construction perspective, we want to make sure that we are fairly diversified and do not take any unintended macro risks. So in reality, if you look at the trust's positions, most of the countries overweight or underweight compared to the benchmark will be within 2 to 3%. Most of the sectors overweight or underweight also will be within 3 to 5%. So we want to make sure that we control this non-stock specific risk and focus all our energies on the stock selection, finding the best ideas across multiple sectors and multiple countries.